Imagine owning a massive mansion, but struggling to pay for a simple dinner because your wealth is frozen. Most people see real estate as the ultimate trophy because you can physically touch your investment every day. Warren Buffett views wealth differently by prioritizing what an asset produces over what it looks like on paper. The core of his philosophy involves the difference between a productive asset and a static pile of bricks. He famously notes that you can buy a farm and it will produce corn and wheat every year. A farm is a productive asset because it creates something of value that people need and will buy. In contrast, a house does not create anything except perhaps a place to stay and a bill. Buffett prefers businesses because they are the ultimate compounding machines that work while you are sleeping soundly. When you buy a stock, you are actually buying a small piece of a living, breathing company. That company has thousands of employees working hard to increase the value of your tiny little share.
If you own a rental property, you are the one who has to deal with the broken toilets. Buffett hates management headaches and prefers that world-class CEOs handle the daily problems for his investments. This brings us to the second major reason for his preference, which is the concept of liquidity. Liquidity refers to how quickly and easily you can turn an asset back into usable cash without loss. If you need money today, you can sell a portion of your stocks in just a few clicks. But selling a house involves realtors, inspections, and a mountain of paperwork that can take several months. This friction makes real estate a very slow way to move money around when opportunities arise elsewhere. Buffett also considers the transaction costs, which are the hidden fees that eat your profits like termites. Selling a house usually costs around 6% in commissions, plus closing costs and various local taxes. Trading a stock often costs nearly $0 in commissions at modern brokerages, which keeps more money compounding.
Then there is the issue of diversification, which protects your wealth from local economic disasters or changes. With real estate, your wealth is often concentrated in one physical location, like a single city block. If a major factory nearby closes down, the value of your house could plummet through no fault. By owning an S&P 500 index fund, you own the 500 biggest companies simultaneously. If one company fails, you still have 499 others working to make you money. Buffett also loves the power of retained earnings, which is money a company keeps to reinvest itself. A great company takes the profit it made today and uses it to build more capacity tomorrow. As an owner of the stock, you benefit from this internal growth without ever lifting a finger. In real estate, your property does not magically grow a second floor or an extra bedroom over time. You must pay for those improvements out of your own pocket, using your own time and hard labor.
Buffett often compares the S&P 500 to a basket of incredible American ingenuity and drive. He believes in the American tailwind, which is the historical trend of businesses becoming more efficient over decades. While real estate prices generally keep up with inflation, businesses have the potential to far outpace it. This happens because companies can raise their prices when costs go up, maintaining their profit margins effectively. Real estate is limited by the local economy and the ability of tenants to pay their monthly rent. Buffett's favorite holding period is forever, which is much easier to do with a diverse stock portfolio. Holding real estate forever requires constant maintenance, property taxes, and the periodic replacement of expensive roofs. These ongoing costs act as a drag on your total return over a long 30-year period. Stocks do not require you to pay for their insurance or fix their plumbing to keep working. This allows the power of compound interest to work at its maximum theoretical efficiency without any leakages.
Buffett often says that the best investment you can make is in yourself and then in businesses. He doesn't hate real estate, but he recognizes it as a different kind of job rather than passive. For most people who want to build wealth while working a normal career, stocks are the answer. They allow you to participate in the success of the world's most profitable organizations with very little effort. Remember that owning your own home is a lifestyle choice, but owning stocks is a wealth strategy. Don't confuse the utility of having a place to live with the efficiency of a financial investment.
By following Buffett's lead, you can focus on accumulating productive assets that generate cash flow for decades. The path to true freedom is owning things that work for you while you are doing what you love. Start small, buy quality companies, and let the magic of time and compounding do the heavy lifting. That is the simple reason why Warren Buffett chooses the stock market over the housing market every time.